Hello and welcome to Nutmeg's portfolio update for October 2019. I'm Bryony Jones, a senior engineer here at Nutmeg. I would like to welcome the new shareholders who have joined the Nutmeg journey through our recent crowdfund. Each month, our investment team give an update on the markets and how our portfolios are performing. This month, I'm joined by James McManus, investment manager and head of ETF research. Hi, James.
Hi, Bryony.
So, after a rocky month in August, it seemed the markets were more stable in September. Is that right?
Yeah, that's right. So August was a choppy month for equity returns, and that was in large driven by an inversion in the US yield curve in the US bond market, which is when long-term bond yields fall below that of short-term bond yields. And that's important because investors have often used that as an indicator of recession in the past. But as we move into September, actually recession fears fell away somewhat, and the Federal Reserve was very supportive of markets by cutting interest rates in the US by 25 basis points, only the second interest rate cut we've seen since 2008. Now that was widely expected, so we didn't see any dramatic gains in markets. It was more business as usual, but a cut to interest rates lowers the borrowing costs to consumers, to businesses, and that's very supportive of markets and the economy. Now one person who felt the Federal Reserve didn't do enough was Donald Trump. He's been advocating further cuts. He would like to see the Federal Reserve stimulate the economy further. Bear in mind it's an election year, so the economic trajectory of the US is very, very important to him at present. He was also in the news because of the impeachment proceedings that were launched against him by the Democratic Party in the US. We don't really expect that to have a significant impact on market events in the near term. What it does do is introduce an element of uncertainty into the sort of political process in the US, and also an element of uncertainty into the timing of any US-China trade agreement that might come to light in the fourth quarter. On the US and China trade, Donald Trump again gave a speech at the UN this week where he criticized China's approach to trade, potentially ramping up the trade rhetoric a little bit further. And then also we saw an attack on Saudi oil installations throughout the month, a drone attack that took out around 5% of world production, and that led to some volatility in oil market prices. What we found though is we find ourselves at the end of September and actually the oil prices reduced back down to that $60 a barrel, $59 a barrel level that it was at the start of September.
So how did markets perform in September?
So developed markets had a positive month. Developed equity markets, the world index finished the month up around 2% in USD terms, and that was led by sort of standout performances in European equities. They were up something around 3.5%, and Japanese equities that had a stellar month up over 5%. So developed markets really recovered a lot of their losses from August. The exception there was the UK. UK equity markets finished the month in positive territory, but they didn't quite get over that watermark from August. And emerging markets continued to underperform developed market counterparts. Again, a positive return, but not enough to get them ahead of developed markets, and that's a continued trend we've seen over the last couple of months. In the fixed income side, much more of a mixed bag. So US government bonds had a phenomenal August. Unfortunately, they gave back some of those returns in September. They finished the month down around 1%, whereas UK government bonds actually rallied on the month and finished in positive territory, really moving with the sort of ebb and flow of Brexit news. Corporate bonds, meanwhile, a bit of a mixed bag. Investment grade and high yield on broadly finished the market flat, but there were some inter-regional differences.
What are the latest developments with Brexit and how is this affecting your investment strategy?
Well, British politics is certainly not boring at present, and we had the latest twist in the Brexit saga when Boris Johnson, the Prime Minister's prorogation of Parliament, his suspension of Parliament was found to be unlawful earlier in the month, and that resulted in the resumption of Parliament and the recall of MPs. Now what we saw here is the pound start to rally against the euro on initial optimism that actually there would be more room for Parliament to avoid a hard Brexit. What we've seen since then, and this is quite typical, is that optimism has faded away as rival factions within different government groups have found increasingly inventive ways to skirt or flirt parliamentary convention. We still think that all options are on the table for Brexit. We're taking a very cautious stance on this. We believe that actually a general election is the most likely outcome. We think we'll likely get an extension, but it could come via a vote of no confidence. But we think that a general election is the most likely outcome for the UK, and that actually the result of that general election is very difficult to call because it will depend on the parties' policies that are put forward, but also whether any parties work together in their effort.
So against this backdrop, how did our fully managed portfolios perform?
Well, the good news is that all portfolios finished the month of September in positive territory after a difficult August. So we had returns ranging from around 0.45% at the lower end of the risk spectrum all the way through to around 2% in our higher risk portfolios.
And with this in mind, have you made any changes to the fully managed portfolios?
We haven't made any changes in recent weeks, though we remain underweight domestically focused UK small and mid-sized companies, which we expect to be most buffered by the Brexit wins. And we do remain overweight the US equity market, as we still believe the US economy is in really robust shape.
This month's customer question looks again at British politics. With another Brexit deadline on the horizon, should I think about reducing my risk level?
Well, it's a good question, and the simple answer is no, and for a number of reasons. The first is, when you're investing, it's really important to stay disciplined and focus on your long-term goal and avoid any short-term market noise or market volatility. That's just good investment discipline, and it helps you avoid the pitfalls of market timing. So really there shouldn't be too much of a need to change a risk level outside of your time frame or your goal evolving or changing over time. Secondly, our portfolios are very global in nature. So whilst the UK is a core investment asset for our portfolios are very diversified. They're globally focused. A typical medium risk Nutmeg portfolio has exposure to around 7,900 underlying securities, and that helps minimize the impact that any one asset, exposure, sector or country can have on the overall portfolio's performance. And then thirdly, for our fully managed portfolios, our investment team is constantly reviewing our positioning to ensure that we're appropriately positioned to manage the balance of risk and opportunity. So that means not just positioning for one particular outcome, but actually looking at the balance of probabilities for different outcomes and positioning appropriate to that. So being able to take advantage of opportunities when they present themselves, but also managing the risk versus the probability of those events taking place. So the simple answer is, the investment team look after and worry about that for you, so there shouldn't be a need to change your risk level.
Great, thanks James.
Thanks, Bryony.
And thank you for joining us. As always, if you have any questions for James, please feel free to contact us via email, social, or in the comments section below. We look forward to seeing you next month.